A 100% statistic leading into 2025, a Santa Claus rally that could be fizzling out, and one of the worst breadth readings we've ever seen into the end of the year. Wow, there's a lot going on in markets right now, whether you're an investor or a trader. But in today's video, we'll be taking a look at what Wall Street could be really up to. Pension funds look to be rebalancing. There's huge moves in the dark pool liquidity, and of course, options flow is starting to heat up. But it may be going to areas that you haven't been looking at in a while. So in today's video, we'll break it all down as we cover stocks, commodities, and cryptos, and the possibility of a huge switch up in one of them. Guys, this is our special weekend edition. I'll see you in a moment. This one's not to be missed. Well, welcome back everybody to The Daily Show. My name's Tom, and I got to say it's great to be back and covering the markets because what a wild couple of days we've seen leading into the end of 2024. We've seen red Fridays, and of course, we've had an overall bit of a switch up week. Let's take a look at the weekend review just quickly here and notice that actually semiconductors were finding some buyers. Now, is that consistent with dark pool liquidity? We'll look at that very, very soon in today's video, but it does seem like maybe the tides are changing from where we were just 2 weeks ago. Let's first start off though with whether the Grinch is coming to these markets. Yes, there are some bad signs and we need to talk about them. First up, New York Stock Exchange advancing issues. Well, as it turns out that over the last 3 sessions, not many stocks were actually up. Never before have we seen less than 20% of the New York Stock Exchange issue advance for one of the last 3 sessions of a year. It got close in 2011, according to Jason Gottfried, but it hasn't done it before. So in similar situations, what have we actually seen on markets? Well, these are the reads, and you can see here with the little green triangles where we were at those times. Is it a cause for concern? Well, as it turns out, I wouldn't say so. I mean, you can see here the stats say it for themselves, but really, other than this one where the markets were already declining pretty heavily, a lot of these reads were actually still the calm before the storm. And this is because often we're looking for the leaders to lead. And as we'll see in dark pool liquidity, that could be exactly what's going on. Let's move over to the other story that I'm probably hearing a little bit around the traps, which is US pension funds. Now, we know that we're coming into the calendar year, and of course, in the US, that's the big one when it comes to locking in profits and doing the switch ups. We often see a lot of liquidity float through into the end of the year, and then all of a sudden it goes dry into January, causing sometimes some flash sells and other things that go on. But basically speaking, we have 21 billion in equities, according to Goldman Sachs. And this is a decent amount. It ranks in the 86th percentile. But overall, I wouldn't worry about it. Yeah, these articles sometimes are used to scare us as investors and traders, but that one itself, I wouldn't be too worried about. Now, what about this one? Is this something we should be concerned of? Stocks have done quite well in the first year of new terms lately, but not historically when it comes to often Republican terms. Now, you may say straight away, but wait a second, when Trump was in, we ended up seeing a massive stock market year thanks to, of course, overall taxation cuts. Well, yes, corporates were cut, and that did lead into some big moves, but you'll notice here that the statistics look very different before to where they look right now. And if we actually break it down and switch it between Democrats and Republicans, you'll often notice that the first half can be pretty good and the second half can be kind of questionable. Now, you've probably heard this stat before, and I wouldn't put anything really on it in terms of how I'd be looking at 2025. We'll talk about that more as we go through it together throughout the rest of the year. But basically speaking, this is still a stat that many people on the markets will be using, and it can sometimes become a self-fulfilling prophecy. The first 6 months, generally positive. The second 6 months, a little bit worse. If we start to see warning signs in the markets, it could all culminate into a very bad effect. We've got a new sentiment survey coming in, and of course, as you would expect, more bears are out there after the tumultuous couple of weeks that we've just seen. Big selling in the markets led to 34.1% of respondents saying they were bearish. Neutrality, I would say, pretty much stayed the same, and bulls kind of disappeared. Now, as we mentioned, dark pool liquidity from Wall Street looks like they've got a base. So basically, there is an area in the markets where it looks like there are buyers, and we did see a large move off that, of course, leading to the markets actually starting the Santa Claus rally so far slightly positively. Conference Board consumer confidence continues to be absolutely ballistic, and you might say, wow, look at this thing. It's an all-time high. We have to sell the market. My goodness, consumers are going wild. But if you actually notice, other than 2000, most of these high reads did not culminate with selling of markets. So again, whenever you're looking at these stats, it's important that you check these out and then you cross-reference them with the markets. And of course, I've done that for you, and I found that there is little correlation, but it's one that I've seen really shared a hell of a lot throughout the markets. Now let's talk about correlations that do matter. Now, putting 2024 in perspective is important. You must have heard, if you've been watching our videos for a while, that I expect a 10% pullback. And there's good reason. Statistically, it will most likely happen in 2025. And we've talked about this a few times before. On average year, we get on average 14.2% return in terms of an average sell-off. However, in 2024, we only saw 8.5% on the S&P. Of course, more was on the NASDAQ and other markets. And of course, overall, the year was absolutely phenomenal. So why is this important? Well, when we think on average what's going to probably happen into 2025, there is statistically a good chance that we will see a 10% decline because it's been a while now. In fact, the last time we saw a 10% correction was now 421 days ago, just before, of course, we started the new bull market. And realistically, this is starting to get up there. We're right on where you would usually start to expect a 10% correction. So remember, the first quarter or second quarter of 2025, we probably expect this to occur. Keep a lookout for the signs. We will be doing so. The next 7 days, are they historically very bullish? Well, when you look at the end of the year, the Santa Claus rally, yes, 1.3% on average generally happens. And you can see here the good reads and the bad reads over time. And yes, there are way more good reads than bad reads. And it does matter. A positive Santa Claus rally is a huge deal for markets. When you have a positive Santa Claus rally, you tend to have a much better next year, that is 2025, than you would during a negative Santa Claus rally. In fact, look at this. Only 5% on average in terms of the return of the S&P 500 versus 10.4%. And you can see how much it skews it. So it's important that Santa Claus actually runs through this year and brings the market cheer. And of course, this is what we've been seeing when it comes to the first couple of days. Now, the first time, that is the first day we saw the Santa Claus rally, so Boxing Day basically, we ended up getting a nice session. Now, we've since seen a bad session, which of course we'll talk about in a moment. But when we see a positive session like that, generally the S&P 500 index returns a overall positive. Now, this is a good sign for people looking to 2025. 100% of the time. And of course, the final 6 days of the return of the SCR overall generally positive. Of course, you can see here there were 2 negatives, 71% positive. So as long as the Santa Claus rally is positive, this is going to be a big deal. And we talk about it as a 3 stack. We want a positive January, we want a positive Santa Claus rally, and of course, we want the Whaley 3-month read as well, which we'll be talking about middle of January. If we get that trifecta, yeah, it tells us a lot about the forward predictability of the markets into 2025, and it should excite all of us as traders and investors as we lead into there. So how does seasonality bullish Santa Claus foreshadow the future? Well, of course, if we do get bullish Santa Claus, you can see here that we end up generally having an okay January. Sometimes it is down. Of course, a positive one is better. A Q1 that's usually pretty good, and a calendar year that's overall generally very nice indeed. So it does matter. It is worthwhile paying attention to. And then you've got to ask yourself the question is the S&P 500 very good at actually predicting the future? Well, as it turns out, it's pretty good. And we know that generally it's fairly good at picking the next president. It's fairly good as well at figuring out what's going on when it comes to the next 12 months. Now, here's a 100% read that you may not have heard of before. So every time the S&P 500 is gained at least 35% over the trailing 12-month period. Now, of course, this was taken as of October to October, so it's important to note that. So it would only lead up to October of 2025, which I think is a very important statistic because, of course, we expect that maybe the back end of 2025 could be nasty. There has never been a recession in the forward 12-month period. So that's basically saying that from October of this year, 24, to October of 25, we should not expect a recession. In fact, even these negative reads, there were no recessions. So could it be that we have no recession chance over the next 12 months? According to Goldman Sachs, we're sitting at about 32%, but it's been dropping steadily since 23. And obviously people are thinking that everything is Goldilocks and everything is fantastic in markets. Let's go through some other reads that are important for us to know right now. The RSI crossing below the 20, which happened just recently. course, we went bullish off that stage with dark pool liquidity showing us why. That was a pretty good read. In fact, again, whenever we see this happen, December 18th was the read of this, then when the RSI goes under 20, it's deeply oversold. Every single time the market was higher a month later. That is that if we took December 18th and we then marked it out to January 18th, we would be higher 100% of the time in those reads. And we also showed this as part of our private trading community. Remember, some of the members there are pretty smart. You guys are pretty smart out there in the community, I've got to say. And you've brought together here one of my favorite reads, which is looking at percentage of stocks above the 5, 20, 50, and 200. And what we found is that when we were oversold like we were just a week and a bit ago, that it was an excellent buying opportunity. So far, so good. But of course, there are some concerns that people will be worried about. So we'll talk about that in a moment. What about instances when the VIX went crazy just a few days ago? Well, of course, again, Fundstrat's done some work on that, and they found that 100% of the time, the recovery was over the next month. So it's all kind of good stuff going on here. Also, if we bought the NASDAQ last week, that is on the Thursday, and we held it to Christmas, and we're still holding it past that, generally speaking, you have an incredible statistic with that one as well, which so far is working out. Now, before we go to the dark pool liquidity, let's take a step back and look at the crypto markets. Are the crypto markets showing us similar signs? Well, we do know that, of course, post the US election, we have to be basically bullish on crypto markets for now. Bitcoin was the first one that we thought, of course, would go, and so far it's been going ballistic. But there have been some concerns, things like Solana dropping against Bitcoin, things like Ethereum coming back down to, of course, the ratio that we'll look at later on. And is this now a big worrying point? Well, as we know, this is kind of symptomatic of potentially a switch. Bitcoin has dominated the headlines so far. People kind of care about Ethereum and Solana and some of the others, but not that much. Are we due for a switch up? Are we due for the altcoin season, or at least some of the other big coins to start going once again? Well, if we look at historical past, you would say yes. Effectively, 1,050 days in between, which is exactly where we've been going so far, we just switched over to this. Effectively, that is a period of Bitcoin domination. Generally speaking, around this period, we tend to see a Bitcoin domination fall off. So could it be that Solana, and others are just getting ready and have shaken out most kind of, we would say, weak hands from these markets? Well, it certainly could be. And remember the stats that we've shared over the last couple of videos. Make sure to go back and check some of those if you're a new time viewer. We showed that January to May is an incredible period for Ethereum. December usually overall positive so far, pretty much sitting on those lines. And January to May, an incredible period of domination. So will we see that switch up? Certainly the stats are saying it's time over the next couple of weeks to start seeing that play out. Of course, price action must come with it. Data and stats are great. We don't see flows. What are we doing? Let's now look at flows. Dark pool liquidity. Yes, this really tipped us off to what Wall Street were doing. Those sneaky cats eating lobsters in the Hamptons without us. Some of you are probably in the Hamptons. I hope you're having a good time. Let us know in the comments down below if you live in the Hamptons, by the way. Maybe one day I'll visit. But over here, we see the S&P 500 ETF, and there were some massive transactions. Yes, they were huge. And across the board, we basically suspected there were buys. And since then, the market dropped and then, of course, rallied straight back up. Now, this becomes important when we look at it in context of what's happening right now. Here are the large transactions. Here are the large transactions that caused the waterfall sell-off. We can see the waterfall sell-off here. We've seen what we have to suspect of buys so far, and guess where prices come back to? Exactly on that point. So what do we need Wall Street to do if this is actually going to hold? Effectively, we need to hold this area. So do we see buyers sitting around this zone? Generally speaking, yes. Where do we see the sellers? Right here. As most technical analysts would know, that is effectively supply. So it makes perfect sense that the market would sell off there. And if you were surprised by that, you might want to go back and do some TA logbooks, because basically that is a very classic kind of sell area. Huge amounts of transactions, bit of a sell. But if we're going to get defended levels, we need to see them right here, right now. And we did start to see on Friday a couple of little sneaky transactions right near the end. Look at this dark pool. This is on the SPY. I'm sure we're all familiar with that particular ETF code. 25th largest transaction in the last 2 years. That is pretty big. The 9th also coming through at around the same level. So what does this tell us? They're most likely defending. So for now, it looks like Wall Street is defending the zone, even from the Hamptons with their lobsters and their biscuits. Even with all of that, they're still clicking the buttons with the algorithms and trying to defend the zone. Let's now have a look at the most important sector. We talked a little bit before about how the market generally leads. Now, there is a chart over on our X account, links in the description and down below, which we have to talk about soon. I think it's 36% dominance of the largest 8 stocks. That is a very concentrated market. And we'll be talking about that into early 2025 because there are some problems there when it comes to the markets. But let's look here at semiconductors. Huge transactions, obviously a fair bit of kind of chop since that point. Now, this is actually quite a few months. And you can see here semiconductors have just sat there kind of dialing around that area. But is it time now for them to break out? Well, let's have a look at some of the most sold semiconductors, one of those being AMD. Now, a lot of people have been asking me about AMD, and I've kind of notoriously said, well, I don't think it's kind of crap stock, but could it be getting good? Well, I think it might be. Look at this, large transaction, good response. And we'll look at it on the charts very soon, but a huge transaction coming through nonetheless for AMD. We also saw Nvidia getting a lot of trades, but there are some bad signs. That is that someone executed a monster trade in bare semiconductors. So is this a take profit? Is this just getting out? What is this? So far, we've seen a little bit of a reaction, of course, in the positive side here, which would mean negative on semis. And we have to be incredibly careful. Nvidia 140 is probably the answer to this question. If we get above 140 to 142, what are we going to start? Positive gamma. Who's going to be the winner? The bulls. If the market stays below that, yeah, the bears have a chance. So we'll go into that in a moment, but let's look at a couple of other dark pools. Big trade here, number 1 largest trade for MSTR, coming through the lows. Could it be a buy? Could be a sell? We'll talk about that soon. And the largest transaction as well on 2 times long PLTRs. So basically this means it's probably someone's taking profit. And we've been warning around PLTR now for a few weeks, as I do not like what I'm seeing here. It could be an accumulation of new positions. It kind of doesn't remind me of that. Does that look like a distribution to you? Buying Climax, UT, Wyckoff, anyone? Certainly could be. I'm not liking the PLTR at this stage. Now let's look at the dark pool liquidity to the flows and of course go through what's been happening over the last 5 days. It looks like here on Friday we saw a bit of a sell-off. I wouldn't say anything in particular. You can see here it was pretty well matched across the board. Most sectors down for the session. If we go over to the last 5 days, though, it reveals something very interesting. Technology up, financials up, healthcare up, which is very interesting indeed, and semiconductors almost leading the charge with 2 of the risk-on assets coming through, solar and clean energy. Now, it's the semis that we need to focus on. The leaders generally lead, the rest of the pack comes after. So we have 36 or 37% of the market index in 8 stocks, which is ridiculous, but anyway, that's where we're at. And we are seeing some of those holding up the market. Is the breadth terrible? The breadth sucks. The breadth is down in the tub. It's so low, it is ridiculous. But at the same time, we're seeing the stronger stocks come through. And this is not necessarily a terrible sign for markets. We've had this quite a few periods before in the 22 to right now kind of rally. So let's now have a look at the charts here for the S&P 500. The week ends as basically a long leg doji. A low, a high, an open and a close at the same level. What is that? I like to call it equilibrium. The market's at a happy point and it likes kind of where it is. If we go over to the futures market, updated a couple of levels here, we're finding levels of support where we would expect them. Between here and here is where market bulls will need to defend that zone. Remember, we know dark pool liquidity was huge throughout this area here at around 58.80. So realistically, if we took a fib from the low to the high, you would find that around here is the 61.8 and around here is the 50% fib. So all of these are okay levels. Where did we sell? Yeah, you guessed it, the supply, which is absolutely fine. So there's no problems with that sell so far. There's really no problems with the sell-off into Friday. The question now is, can Santa rally this thing back up? Or is a Grinch going to come and take a new low? A new low is not good. And when you go and look at the markets, you take a look at the weekly in particular, you can really get an idea of why it's not good. Take a look at this. The 20 weekly. We love the 20 weekly. 1, 2, 3, 4. New highs each time. If we go and sell underneath that level and realistically don't hold 5,700, ooh, that is bad, okay? That is not good at all. We could be pushing down into 55s, 54s pretty quickly. So do we want that to happen? I wouldn't, because at the moment, the markets basically statistically are really more in the upwards flow. But you've got to remember who is in the control right now. Generally speaking, it's the bulls. The question really will be, can they regain that 60-50 level? Now, speaking of 60-50, you're going to see that come up quite a lot when it comes to zero DTEs. For the next trading day, the next 2 trading days into the end of the year, you can see here 60-50 is the call wall. That is for the last trading day of 2024. And for the second last day, there are options everywhere. In fact, you'd almost want it to be a pretty flat session between around 6,000 and maybe 60-50 would be okay, somewhere in this zone. Look at all these puts, look at all these calls. Tons of money to be made by market makers if they can keep it kind of in a kind of compounded area. They want to keep it not too large in terms of the overall flows. Now, why is this? Well, there's a lot of options both ways, and it seems like people are speculating both bearish and bullish. If the market goes underneath 59.50, it could put a lot of downward pressure on the markets. If the market stays between 59, kind of 60.50 and 60.50, I think there's no real problem. So again, zero DTE is not as clear for the next session, but very clear where we enter into positive gamma, which is going to be 60.50. And if you scroll down, you can see here that 5,900 is a monster put for January. So again, I wouldn't be too worried being a bull right now. There seems to be a decent amount of potential pressure to the upside if we hit some of these levels. Let's now move over to Tesla. Now, Tesla's been a little bit struggle town. It's 431 here on the charts. You can see that 400 is where we've been angling in on puts. So that's the put wall. And really 450 at the moment to 455 is where we have the call wall. Now, there is quite a lot of news coming out about Elon and Trump. That's really all that matters at this stage in terms of valuations. Forget about it. So mostly it's going to be options flow. And for now, we may see some consolidation after that large move, even sell pressure. Remember, 400 is the main level you want to be looking at if you're interested in getting back into Tesla. Nvidia positions, well, as we mentioned before, 140, 140, 140. Yeah, guys, we get through 140, good times. That will actually show us that the market is keen to move to the next levels. So we will be watching that. And of course, 135 is currently the base structure. So we're trading between 135 and 140. We break through 140, good for the bulls, probably a go signal. And we break below 135. We have to look at that in further detail. Just before we jump into the charts and we take a look at all of the other stuff we need to be watching, including some of the lead indicators, I want to say a big thank you to the sponsor of today's video, which is Tiger Brokers. Now, guys, especially if you're from Australia, check out Tiger Brokers, links in the description down below. Not only have they won so many awards in 2023 and 2024, they're also giving you guys a special promotional offer. If you go and deposit 2,000 Australian dollars within the first 7 days, then you'll get additional cash voucher bonuses along with some other stuff. But why do we like Tiger Brokers? Well, firstly, it has to do with them constantly upgrading their software and also giving better deals to you guys. If you don't know it, but from Australia, they are now CHESS sponsored for ASX stocks, which is absolutely incredible. And they have competitive fees and brokerage switches, which is very important if you want to trade some of the best markets in the world, such as the US. But I think far and beyond anything else, it has to do with 24/5 markets. And this goes for any of you guys out there right now. You need these types of access because why? It's all got to do with earnings season. Yes, this market is now 24 basically 5. Let's hope not 24/7. Some of you guys want that. I think that would be a disaster. Let's not go crypto ways. But generally speaking, we have access to 9,500 plus stocks, ETFs, zero additional fees. The vouchers are accepted, it looks like. And of course, you can trade post earnings, which means that you don't get those really nasty kind of hunts that happen to you when you are not able to trade. So if you haven't already done it, check them out in the links in the description down below. They've got a whole bunch of different offers for different members around the world. So whether you're in the US or in Australia or somebody else in Singapore, there are some different offers down below. Check them out, guys. And thank you very much to Tiger Brokers. Let's now jump on over to the charts and have a look at the US 10Y here. And what I want to mention was, of course, yields. Now, we've seen this one break out. There's no doubt that this is a negative sign. So there are, of course, some bad signs in the markets. The first one is yields. We will have to watch 4.7 in particular, and you'll want to pay attention to this level. So 4.7, we'll be watching it. It's broken the downward trend line, and I would say that it should be pushing towards 4.7, and that is a little bit of concern. Now, you might say, well, wait a second, yields up means growth. Yeah, but the market's, of course, pricing in some other things. Now, if we take a look at the bonds indicator right now, it hasn't gone down. So generally speaking, what you would usually expect is if the VIX spiked above 20, which of course it did, then it dropped the way it did, you would expect the bonds to also drop off in terms of their fear, because this is the bonds fear based on options. Now, in this case, they haven't dropped much. And that's telling us there's still a little bit of fear in the markets and we need to see that level being defended. So we'll be watching that one. Home builders also sucks. And of course, we know that this is not a sell signal across the markets, but it's something we need to watch into 2025. Home builders has now found defensive support, but if it breaks underneath 26, that is going to break, or this level here is going to break, of course, guess what? Yes, that's right, the upward trend. So this is going to be a significant problem in 2025 should we see it, and it could show the signs of the cracks appearing, which we suspect to be happening over the next year to year and a half. Let's move over to US dollar, pretty strong weekly close. I'd say this could mean that the US dollar is going to continue up and continue its strength. We'll be watching it very closely. If you're in the upward trend, you've still got to hold the upward trend. As we mentioned, this is really about, can we break underneath 105.70? At the moment, what we've done is we've created a double bottom here. We breached it here, and we're still moving up. And the weekly close kind of confirms that there's still potentially further bullishness for the dollar. So I wouldn't be going against that, that's for sure at this stage. Let's move over to gold. Well, gold has been struggling a little bit. And as we know, strong dollar could be a bit of a problem for gold. It's trading at that first trade zone. We're still maintaining 26.65 as where the bulls take over this particular trade. Silver, same thing. Head and shoulders, I understand. Neckline, people are shorting here. For you to be bullish in silver, you're going to need to see a 31.15. Smaller time frame traders may already be bullish silver, but you'll really want to reclaim this high. So small time frame traders will be basically buying it as of here, 29.35, putting stops below the low and realistically angling in at that 31.15. If you then get above that, wow, you could be looking at a pretty significant trade. But it's early days for silver, and of course it's against that head and shoulders trend. So we'll see how that one ends up playing. No real activation. Oil still remains slightly bullish. As we know, it's kind of chop city. It's a very difficult trade, but we did see it break through that trend line, and it so far has defended it from the top to the below. So we're seeing here defensive levels, and that's not bad for oil. Let's now move over to some of the bigger stocks. We'll start off here with Tesla. As we've mentioned several times, we think kind of the buy pressure is sitting about 400, and the sell pressure obviously is at the 490s to 500 level. So we're stuck in this 100 range. We would think that Tesla has probably had its massive move now. And the reason you can say that is because when you go through history, whenever you see these huge rips in Tesla, it always ends up kind of really crappy afterwards. So we get that real consolidation, or you get even a decent decline afterwards. And you can go back through history even before the blow up in 2019, and you'll see the same thing. So has Tesla done it? Yeah, I think it has, and it was probably going to consolidate, and there'll be some good day trading on it. So of course, we'll keep following it. We're looking particularly for 400. And if you go back over here, what may happen actually is the 20 moving average may catch up in the consolidation, and then that could start the next trend. So at this stage, it's all going to be about options, and we'll keep covering it. Let's now move over to semiconductors. So far, so good. Yes, it was sell-off on the semis, but then they held by the end of the day. Buyers came back in, they bought the dip. Now, we are looking for a 254 on the SMH in terms of a breakout, and that's going to be significant. Of course, we've been looking closely at semis because we're seeing weird transactions. Wall Street's kind of showing their hand here, and it's in these large transactions. Look at this. Even AMD getting larger transactions near the lows here at 120. A few of you guys really like this stock. I think it's kind of interesting now that it's back down at these prices. It's swept the lows over here. I'll be looking at 133 as kind of like a target to say, okay, yes, this actually is going bullish. But for now, early signs are good. And what I mean by early signs, large transactions, decent support base on weekly demand. and we're starting to see a little bit of a reaction. So as we often say, if you have patience and you see reactions, that's a good sign. We're really still looking for this level up here of 132-ish, 131 to be broken. That happens, good sign at this stage, just early days there. Nvidia is kind of similar. We like Nvidia a lot more. I know everyone's been going on about the head and shoulders. We do have some bear bust kind of potential as well, but we are at that important zone, 140 plus. We get a close, beautiful. What you'll notice is that over the last couple of trade sessions, look at this. We trade right on 140, right on. No coincidence. That's exactly those call levels. And this is important because, of course, if we break through this, we're killing all of those shorts that are in this head and shoulders trade. Once you take out 146 and you destroy that area, then of course people are going to be getting squeezed. So there could be a squeeze play here. It could tell us a lot about the markets. This remains possibly the most important chart for us to be watching. Hong Kong 50 doing exactly what we would suspect. Looks really good. Reclaiming above that 20,000. Fantastic alert to be set. And so far, we continue to be bullish on China into 2025 based on the price actions that we've seen so far. So some good signs there coming out of China. I'm sure a few people are happy with that stock. Now let's move over to the US 2K. Now the Russell 2000 is right where you would expect buyers to come back in. So again, do we want this level defended? Yes. Do we want a new low? Ideally not. That would be better. And we would like to see buyers come back in now. Now, is this weaker than the S&P? Yes, because we have a concentrated market buy, not a broad buy at this stage. But still, the US 2K is at an incredible zone. And as we mentioned, when it fell off, it fell straight into where we call, good buy zone, but basically a very key level, one of the most traded levels that we've seen in some time. So again, it's important Wall Street continue to defend that base. NASDAQ still looks pretty similar to the S&P. We think the S&P chart looks better. There are arguments to say this is a big short here. It's going to push lower. The data doesn't point that way just yet, but of course you keep your eyes open. We'll play both ways if necessary. For now, I'd say the buyers are in more commitment control. Let's move over to Ethereum. Ethereum holding itself versus Bitcoin. Okay, actually finding decent strength. January should be a better month for this coin. And you can see here, Ethereum is barely holding onto that second support. Now, if we get above 35.50, yeah, it's good times. So things are looking exceptionally good there. We really want to defend this zone. So Ethereum really has to find buyers right here, right now, as does Bitcoin. Because guess what? If you look at Bitcoin, I'm sure a lot of people are doing this right now. They're going to be looking at Bitcoin and saying, oh, that's a head and shoulders. It is over, baby. And we are going to short this all the way down. There's the head, there's the left shoulder, the head, and the right shoulder. This is, of course, the neckline. There's no doubt that 92 is important. So I think between 88 and 92, that is where all buyers must commit. And if they're not committing there, we've got a problem in Bitcoin and possibly the rest of the crypto market. For now, still buyers, still committing, like to see it. But I think Bitcoin is starting to weaken against the other coins. And what that means is that if we look at that 1,050 days that we saw before, this would be the time. This makes sense. Question is, will it actually happen? And we'll be watching that flow into 2025. So make sure to subscribe for that, guys. In terms of what's going on this week, we'll have some other videos coming out. We'll be a little bit less videos than normal, guys, because do remember, I do take a small break over this period to spend time with the family and friends, and then we'll be back absolutely smashing it out in 2025 during all those important times. Remember, we do generally make daily videos, so make sure to subscribe for those. If you're interested in the Christmas sale, you can check it out, and the link's in the description down below as well. We do have a deal that's going on now that will not be repeated because, of course, we will put slightly up prices into 2025. So make sure to check that out. And if you haven't already done so and you're from Australia, check out Tiger Brokers. They may be correct for you. And look at the links in the description, including the special offer for FX Evolution members. Thanks so much for watching, guys. I hope you have a fantastic time. I hope you have a great new year. And of course, when we see you next on the videos, we'll be talking about all these important things in markets. Some great setups happening right now, surprisingly decent trade volume, and of course, that chance of the Grinch. So we'll find out whether that happens. For now, I still think Santa is ruling supreme. Bye, guys.